Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glenn Sutherland.
Welcome to another episode of A Canadian Investing in the U.S. Kim and John started investing in real estate 5 years ago. Their first investment property was a duplex, and after renovating both units over a period of 2 years, they ended up selling it for a profit. They then purchased a larger home with a basement apartment. From there, they have purchased 5 more properties, including 2 multi-unit joint ventures, with a third being finalized currently. Their property currently stands at 4 properties with 14 doors, a 10-acre bush, and soon-to-be-built log home for Kim's parents. John and Kim also have self-directed RSPs to private lend on real estate and participating in larger land development projects. John is a licensed bus mechanic, and due to their real estate income, he has dropped his hours to part-time. Kim works as a content communications and production manager for a real estate investing company in which they are both very active members. John and Kim find, manage, and do most of the repairs of the properties they have themselves, but they're currently transitioning to their team of contractors to continue to grow their portfolio. So, John, there is a lot here.
Yes.
You're a very busy guy. So we could tackle this, I guess, 3 different ways. I guess there's the joint venture, there's the self-directed RSPs to private lend, or there's the reno. What were you thinking today?
We could talk a bit about joint ventures if you like.
Sure, that sounds great.
We're mostly the active working partner in our joint venture investing. We mostly meet new JVs through either our first JV partner, through word of mouth, or through a lot of the investing groups. Then meetings that we like to do is the ones we have met at as well, Glenn. And we mostly do our stuff right now in London, where we're located, because it's something close that I can manage quite easily. And we just started talking and seeing if we can help our money partners, join up and see if we can make them a good return.
In this scenario, I guess you're the partner that finds the deal as well, right?
Yes, we like to find the deal. Generally have a discussion with partners to see kind of where they're at as far as down payments for what type of properties they're interested in, whether it be multifamily, residential, commercial, and then kind of looking at their long-term goals to see what if that kind of aligns with our investing stream as well. And then we tie up the property and then offer that out. That way they have a chance to digest the property and see if it's going to work for their numbers wise.
Yeah.
And then we kind of hand it over to them to finalize the deal, and we help them along the way as far as making sure they have the right financing and things in place. And then once the keys are in hand, then that's when my real work begins from there.
The one partner, which would be you, are the one who finds the deal, and they would be then the ones who have to qualify for the financing and come with the money, correct?
That is correct.
Maybe let's run down one of your deals.
Sure. We'll talk about maybe one of our first JVs. So it was a underperforming rehab 4-unit residential property. Mm-hmm. We were able to negotiate about $50,000 off the asking price, as well as numerous amounts of conditions to bring it up to a little bit more safety standard before we even took possession, which was a rare deal. Where you normally you either get either price or terms, but in this case we got both. So that was a bonus. Yeah. And then from there we had intentions of doing one renovation, which a unit was vacant when we took possession. But over the course of the year, we actually ended up doing 3 out of the 4 units. So it was a little bit more of a project than we were anticipating to begin with. But at the end of the day, we got some great tenants in, increased the value of the property quite a lot, increased our cash flow, lowered our expenses, and we're able to refinance that property within a 2.5-year period, which again was something we hadn't planned on, but it turned out to be the best idea to do.
Do you have like an exit strategy for the joint venture? Like, is it like when you said 2.5-year refinance, is that like the close off and either the money partner's out or you're out, or the intent's to keep the property?
Most of ours are buy and hold, so we like to keep them.
Yeah.
The original intent with that property was to probably refinance after the 5-year mark, because we actually did a 5-year term for financing.
Yeah.
But it was worth our while with the mortgage rates the way they were to break that and even move into a slightly higher interest rate, but with a better lender, from a B to an A lender, mm-hmm. And draw that money out of the property for not only us but our JV partners, so that from therefore we had no money in the deal, because we actually put some money in the first deal ourselves, just because we thought that we would feel better doing that. And our partners are now in for about half of what the original investment they put in, so there are essentially doubled from that point on as well. So
Yeah, and I found like when you talk to people who haven't worked in a joint venture or seen this structure before, they tend to be a little more comfortable whenever they see that both parties have some skin in the game.
yeah, we structured the deal so that essentially we were doing mostly the renovation on the one unit that was vacant when we took possession. And really, if we didn't do a good job, we wouldn't have received our return on investment. So it was advantageous for us to do a great job for not only us, but for our partners' money. And back to the original question about our exit strategy, we kind of like not only buy and hold, but also put in the stipulations of, depending on the market, if the property turns out to be a fantastic deal that you refinance a lot of money out, but now it doesn't cash flow, then that would be the point in which we would probably sell out, and numerous other areas that if one partner came into the financial strategy that they could pull their money out and do something better with, then the partner would have the option to buy them out or bring in a different working partner and vice versa. So there's lots of different strategies we talk about.
That's perfect because, you want to have more options, then everyone's more comfortable and everyone knows how it's going to play out, so there's no surprises whenever something doesn't go exactly the way the main goal was to go.
Exactly.
Excellent. Have you thought about just using a debt partner, like a private lender, instead of like actually sharing equity with somebody?
We have, but we've come to a point in our portfolio where we can't qualify for any more mortgages. So that's kind of their point. But to your point again, we can also bring in just a partner, just to sign on the dotted line, basically to do the qualifying and offer them a percentage to do that, and then essentially have more or less the rest of the deal from that point forward, which is also something we have thought about. We've run that by a few people. My sister, for example, has never purchased a property and probably won't for herself. She enjoys just renting and having that freedom.
Yep.
But she would also like to own real estate and see that advantages of that through what I do. So she's already said that, if you ever need me to qualify for you, or we'd like to do a deal only out your way versus in Toronto area where she is, that would be kind of the strategy which we would play. So.
It's a great situation to be in.
Yes. Of the private lending side, I would highly recommend it if you would like probably a little bit better of a return than what you're currently seeing probably through most of your investment portfolio managers. The fees to do the deals are generally paid for by the person you're lending the money to. The self-directed accounts which you hold your money in have a very small yearly fee compared to what you would hold in a major big bank or another investment company.
Yes, yep.
And you can move your money in and out as much as you want. So if you want to do some short-term deals like 2-3 months on a refinance to flip a property, or just a general refinance to get a better term, that's one way. Or you can look at some bigger deals where they might be doing a large-scale renovation that might take a year and a half. They're adding units. All along the way, they're adding some value to the property, which makes me feel better about my investment when I lend out to them. So I do first, second, third mortgages, interest rates depending on which one we take. Of course, the better the position, the less risk, the less interest you're going to get.
Yeah.
But I've done everything from 10% first mortgage on a fourplex all the way up to 15-16% on a second for a medical building.
Do you just do the promissory notes, or do you do you actually go in position, I guess?
I generally go in position. I haven't ruled out a promissory note as well. I've done them privately, and I've also done them through a company that's strictly what they do is private lending. So they send me the deals, I oversee them. If it's something that suits my portfolio style, then I'll say yes or no, and then we'll set it up from there and go. I could talk about probably which is probably a little bit less known, is the land development side of things. So being owning a very, very small chunk of a large development, be it of a condominium building or some of the sort. Mm-hmm. There's a few companies that do that type of thing, and it's a security company that is governed by Government of Ontario, so you have to meet certain qualifications in order to do that type of investing.
So you're talking right from ground up construction of a multi-unit.
Basically, so the companies that I work with, they acquire the land in which is suitable for certain types of builds, be it a whole community of 400 or 500 homes in shopping centers, or just a condominium in either Toronto, or, for instance, I'm doing one in Florida right now, where your name is a part of part of the title, so I can say I actually own a very small piece of dirt down in Miami right now. But with the knowing that when I receive the deal, that they've already done their due diligence and that the property can take the building that they're wanting to build.
Yep.
And the outer portion is going to a lot of the costs that the builder doesn't normally take on until you get to a certain point of financing where they can get financing from a regular lender, and that's how they do their deals. So when I know when the shovel hits the ground that they've already broken even, I'm pretty confident in my returns that I'll be receiving at the end of the day. The projects like that, your money has to go out for a certain amount of time. It could be 3, 4, 5 years. It's a longer term and once the money goes, you just can't get it back. So it is something that you have to say, that is feel free to leave for 5 or 6 years if that's the case, and knowing that you just can't grab that back, which is the negative versus the short-term private lending that I also do. So I kind of like to dabble in both. That way I can see bigger long-term returns on money that's in my RSP I'm not going to use anyway. Mm-hmm. And then some of the shorter-term stuff, I use my RSPs and my cash, so I can get monthly income or monthly income going right back into my RSPs. So it works out well.
So as it's in Florida, do you have to go through getting an ITIN and do the whole setup, or just because you're a debt partner you can get around all that, or do you file with the IRS every year?
No. Through this type of investing, you don't have to. Okay. It's all done through the securities company that we deal with here in Canada. It is in funds of U.S. funds or the equivalent of. So in my example, I'm allowed to do $25,000 a deal. If you meet certain other income and criteria that they go through, you can invest up to $1 million plus if you're in that capability. So, but it is nice that you don't have to qualify, as you say, for what you would normally do for just buying a house, so to speak, in the States.
Excellent. If someone wanted to get in contact with you, how would they do so?
Well, probably the best thing would be to check out our website at rethrive.ca. Our contact or our email address is contact, all one word, at rethrive, spelled RETHRIVE.ca. So again, that's contact at rethrive.ca. And from there, you can check out kind of what we post on what we have vacant and not vacant, what we've rented out in the past, and kind of the renovations of what types of units we like to offer our tenants. And our JV partners can also go into a different page on the website and kind of find out more about the ROIs on their current deals and what we like to shoot for in the future. And from there, they can find a little bit more about Kim and I and shoot us a question if they have any. And yeah, that's about probably the easiest way to get a hold of us.
Thank you for coming on the show, John. It was a pleasure.
Glenn, I appreciate the time. Thank you very much for having me.